The Banking, Housing, and Urban Affairs Committee will come to order. Welcome back. Director Chopra, good to see you again. Thank you. We created the Consumer Financial Protection Bureau to fight for all the Americans who have no other way to stand up to powerful interest groups and powerful corporations. Look at the action CFPB has taken since Director Chopra last appeared before us. CFPB is going after those that discriminate in home lending, provide shady financial products, prey on the elderly and students and service members. Since its creation, CFPB has returned $17.4 billion. 17.4, that's $17.4 thousand million to more than 200 million Americans. $17.4 billion that otherwise would be in corporate profit statements is now where it belongs, back in consumers' wallets. Just one action, CFPB returned millions to service members by going after a title lender that violated service members' financial rights. They protect consumers from being forced to pay debts that they do not owe to nursing homes. They're working to ensure homes are valued fairly, helping working families build generational wealth. They're going after junk fees. Of course, Wall Street doesn't like what the CFPB does and never has. After all, corporate lobbyists aren't paid to just sit around and let consumers win. So what do Wall Street, the Republican allies in Congress, their army of lobbyists do? They go to war against the only agency created to protect consumers. They've tried every tactic to gut the CFPB. They tried to cut its funding. They tried to take away the effective single director structure. They tried to dismantle it from the inside under Mick Mulvaney and Kathy Kraninger. None of that worked, at least not permanently. Under Director Chopra's leadership, CFPB is back to doing its job, standing up to bad actors, protecting people's paychecks and savings, helping working families. It's pretty simple, keep more of their money. But the corporate crowd never gives up. Now they've used Wall Street's favorite circuit court to try to get rid of the CFPB. Last year's Fifth Circuit ruling is far, far outside the mainstream. They're saying that CFPB's funding authority violates the Constitution's appropriation clause in the separation of power. That's frankly, I'm not a lawyer, but I can see that's frankly insane. By establishing reliable and steady funding, we ensured CFPB would be able to fully protect consumers. For more than 2 centuries, Congress has used and the courts have recognized a variety of different mechanisms to fund agencies and programs. In creating CFPB, we intentionally chose to fund the Bureau in a way that guaranteed steady funding without political interference. And we know that there would be lots of political interference during this. Just as other financial regulators like the Federal Reserve are independently funded. They're not going after that with the same verve as they do the CFPB, of course. If the CFPB's independent funding structures is unconstitutional, there's going to be far-ranging collateral damage. The Fed would be in jeopardy. So would the FDIC. Does Wall Street really want that to happen? These are entities vital to our economy and to how corporations operate, yet Wall Street doesn't seem to care because they dislike the CFPB so much. This lawsuit is a half-baked, bad faith, dangerous legal ploy to do through the courts what Wall Street and their congressional allies in Congress couldn't get done any other way, get the CFP off their back. That's the end goal here, to allow corporations to pad their profits with working families' hard-earned money with no one standing in their way. Just look at Wells Fargo. In the most recent of a long line of abuses for years, CFPB, this is just the most recent one, found that Wells Fargo mismanaged auto loans, mortgages, bank accounts. The bank wrongfully foreclosed on homes and illegally repossessed vehicles. That's a traumatic event in a consumer's life. CFPB uncovered this misconduct that affected 16 million consumer accounts. 16 million consumer accounts. The agency ordered Wells Fargo to repay $2 billion, that's billion with a B, to millions of consumers. For many of these consumers, these customers, they had no other way to get their money back. Some of them may not have even known they were wrongfully foreclosed on if the CFPB had not stood up for them. That's this agency's job. The CFPB is helping Americans save money on their homes and their bank accounts and their medical bills. And then take mortgages, for example. Unlike in 2008, today the largest mortgage lenders are non-banks that aren't even overseen by the federal banking regulators. CFPB is charged with policing all lenders to make sure they're making mortgages on fair terms. Without CFPB, consumers' biggest financial investment, their key for many, many, many millions of middle class and working families. Their key to generational wealth would be at risk. The mortgage market would be in chaos. The director knows all that, I can tell from the look on his face. Or look at the progress the CFPB has made on reducing junk fees like overdraft fees. CFPB estimates that consumers will save $5.5 billion. Again, that's billion with a B, on overdraft fees due to the recent overdraft reforms made by banks after many of us in the CFPB put pressure on them. That's $5.5 billion Americans can instead use to put food on the table, pay their utility bills, put gas in their car, maybe save a little bit money for their son or daughter to go to community college. Make no mistake, these overdraft reforms, the $5.5 billion in savings, would never have happened without the Consumer Financial Protection Bureau. CFPB's work on medical debt will also have a real effect on tens of millions of Americans' finances. Together with CFPB, we pushed the three major credit reporting agencies to remove medical debt under $500 from credit reports. This committee, beginning this year, brought for the first time all three CEOs of the credit reporting agencies to the table that you're sitting at because it's so important that we oversee them better than we have in the past. That's what CFPB's done. It's time this committee does too. That's going to mean 22 million consumers will have at least one medical collection removed from their credit reports. Think of that. Those American credit scores will increase by an average of 21 points. We know that a better credit score means lower interest rates and lower costs for consumers. All these accomplishments, all this work means more money in working people's pockets, less money for stock buybacks and executive bonuses, because that's what it's all about for them. It's exactly why Wall Street and its allies are intent on destroying, and that's not an overstatement, destroying the CFPB. They always have been. The people pushing this case don't really care about whether the CFPB's funding model is unconstitutional. The only reason the corporations and their enablers on Wall Street have singled out the CFPB is because the agency doesn't do their bidding. CFPB doesn't help Wall Street executives when they fail. It doesn't extend them credit in favorable terms or offer them deposit insurance like the other regulators do. No other agency fights for consumers or stands up to corporate power like the Consumer Financial Protection Bureau. Most Americans don't have high-priced lawyers. Most Americans don't have corporate lobbyists, but they have you. They have the CFPB. It's our job to make sure that it will be the voice, their voice for decades to come. Ranking Member Scott.
Thank you, Chairman Brown. Back in March, we had a few things going on that month. So we would not be remiss in forgetting that the President submitted his budget. But while this committee was consumed, and rightly so, by the bank failures, President Biden charged ahead with a progressive wish list of reckless spending, higher taxes, and failed policies. Thankfully, our government has a system of checks and balances, one of which includes congressional oversight and the power of the purse appropriations. In these important and trusted roles, we analyze and scrutinize the executive branch's actions on behalf of the American taxpayer so that the voices of the country's citizens are heard and their viewpoints reflected. Unfortunately, the Consumer Financial Bureau Protection Bureau, or the CFPB, is a notable exception. It is not accountable to Congress or the American taxpayer through the appropriations process, and it is routinely, brazenly acts outside the scope of its authority. And Director Chopra has taken full advantage of that loophole. Under your leadership, the CFPB has implemented policies and practices that will ultimately reduce consumer options and curtail reasonable practices that promote financial responsibility, further eroding access to credit. Director Chopra has created uncertainty in the marketplace by attempting to regulate through speeches and issuing blog posts under the guise of clarifying guidance. The result of rulemaking and enforcement by a blog post? Fewer consumers are actually protected and fewer options of financial products will be made available. Instead of serving people, companies are forced to maintain the status quo or withdraw service offerings out of fear for retribution by nastygram. Whether it's reputational harm through a CFPB press release based on a unique and flawed interpretation of the law or an assessment of risk exposure, the result is the same: less credit access for those who need it most. The CFPB's website boasts of how the agency's enforcement actions through 2022 have yielded $16 billion in consumer relief for 192 million consumers. But in reality, This means that the average consumer under the CFPB's protection would receive a check for around $83. Of course, $83 is still $83, but we have to ask ourselves, what is the real cost of those enforcement activities? How many billions of dollars have your actions actually cost consumers in the form of higher prices, reduced access to credit, or in lost opportunities for new products? Further, since his last appearance in front of this committee, Director Chopra has continued his public pressure campaign mislabeling legitimate payment incentives as junk fees or illegal fees. This sweeping initiative lumps legitimate standard credit card late fees in with the White House's political efforts to bring down fees in other sectors. Let's be honest, no one likes paying late fees, but they do encourage financial discipline. When you pay your credit card on time, your credit score goes up. When you don't, it goes down. And when your credit score goes down, it makes it harder to get a car loan, a small business loan, or even a mortgage at a better rate. So I'm concerned that the CFPB's crusade on junk fees will do more harm than good and actually end up restricting access to credit for low and middle income Americans with limited credit histories. To make matters worse, this proposal has major gaps and errors in the data used and the procedure applied. Just read the Small Business Administration's Office of Advocacy's comment letter, in which the SBA expresses concerns that the CFPB does not have the necessary data to develop an adequate or factual basis for its certification. In other words, members of the executive branch, your colleagues, have serious concerns around this rule. If this rule were to be finalized, the end result would be increased cost of credit for all American consumers and less access to credit for those who need it most. I really just simply can't understand how that would protect consumers or be beneficial for everyday Americans and Main Street businesses. To make matters worse, under your leadership, the CFPB learned of a major data breach in its own backyard, impacting more than 250,000 consumers. At the same time, the CFPB was finalizing the rules that requires lenders to collect and report a vast swath of small business lending data on credit products, including personally identifiable information like race, sex, ethnicity to the CFPB. The irony here is just astounding. Why should we trust the CFPB to collect more data on millions of community banks, small businesses, and individuals when it has failed to maintain safekeeping of the data it already collects? These obvious and repeated failures raise an important question. How can we protect American consumers from the actions of the CFPB? I honestly can't believe that's a question that needs to be asked. But it is indeed. But that is where we find ourselves today. I hope that during the question and answering time of this committee, we'll have an opportunity to engage in some of the important answers to the questions I'm asking. Finally, I think it's important to note that I'm a firm believer that the best way to provide economic opportunity and protect American consumers is to encourage competitive markets, innovative products, and set clear rules of the road. These principles have provided millions of Americans, like myself, the opportunity and ability to overcome poverty. It is absolutely necessary that we protect our principles. But what I find so disappointing is that the American public cannot trust this agency, this administration, or this director. And that is truly a shame.
Thank you, Senator Scott. As I'm introducing our witness today, I point out that the White House that nominated Mr. Chopra, this administration, in its first 29 months has created more jobs than any four-year term administration in our nation's history. So I think that's important always to remember the work that Mr. Chopra does and others in the administration. The Honorable Rohit Chopra is Director of the Consumer Financial Protection Bureau. He previously served as FTC Commissioner. After passage of Dodd-Frank, Director Chopra joined the CFPB as Assistant Director and then was appointed CFPB Student Loan Ombudsman. Lots of experience there fighting for consumers in all facets. He subsequently served as a special advisor at the Department of Education. Director, please proceed.
Chairman Brown, Ranking Member Scott, and members of the committee, thank you for holding this hearing on the CFPB's submission of its semi-annual report to Congress. I'm pleased to report that the CFPB continues to deliver tangible results for the public today, ensuring that consumers are protected while also preparing for the future as big tech and artificial intelligence reshape the industry. I want to share a few observations about the state of American consumers, as well as some highlights of the CFPB's work. American families continue to benefit from a resilient labor market, and consumer spending continues to be quite robust, and borrowing has accelerated. Americans now owe $17 trillion in household debt, including mortgages, student loans, auto loans, and credit cards. Inflation in key categories such as vehicles has contributed to rising levels of debt. Interest rates are substantially higher than they were a few years ago, and some families are paying much more on their credit cards and other loans. Overall, current indicators of distress on consumer credit remain muted, though there are modest signs of increased delinquency. We'll continue monitoring the impact of changes in interest rates and home prices closely, as well as other changes that might impact large segments of the population. The CFPB continues to be on high alert for shocks to the system that might unsettle household financial stability. The failures of Silicon Valley Bank, Signature Bank, and First Republic Bank highlighted some vulnerabilities in the banking system, and regulators took a series of extraordinary actions that limited the fallout to the broader economy. But it is clear we will need to take steps to avoid the need to take emergency measures in the future and for people to know their funds are safe. With respect to congressional directives, CFPB has made major progress to propose, finalize, or implement required rules on credit reporting for survivors of human trafficking, small business lending data collection, PACE lending, the transition from LIBOR, and so much more. We're reviewing old rules to find opportunities to simplify and future-proof them. We've built on the work of my predecessor to publish more guidance and advisory opinions that especially help small and nascent firms looking to develop innovative products and services. We're focusing more heavily on supervision of non-bank financial firms, which have not always been subjected to similar oversight as local banks and credit unions. We've activated unused authorities to minimize regulatory arbitrage by non-bank firms seeking to gain a competitive advantage. We've shifted the focus of our enforcement program away from targeting small businesses and putting more attention on repeat offenders. Since then, we've recovered $4.6 billion in refunds and penalties against violators of the law. We're handling an average of 10,000 consumer complaints each week and obtaining successful resolutions for individuals outside of formal legal proceedings. Equally important is our work to address how technology is transforming financial services. I think the U.S. has a choice. Will we harness technology to maintain and enhance relationship banking, to drive competition and protect privacy, or will we continue our lurch toward a system marked by surveillance that is more automated and controlled by just a few firms? The CFPB is working to ensure broad benefits for consumers and businesses alike when it comes to technological progress. One of our most important initiatives is to accelerate the shift in the United States to open banking, allowing consumers to more easily switch and gain access to new products while still protecting their most sensitive personal financial data. And privacy will continue to be high on our mind. We're leading a number of efforts on artificial intelligence, and we're working to bring on more technical talent inside the agency. We're taking steps to guard against algorithmic bias across markets, and we're working to ensure that data brokers respect long-standing laws on the books. The work of the CFPB in today's digital economy is more relevant than ever. Thank you again. I've appeared before this committee many, many times, and look forward to hearing your questions.
Thank you. And with your performance and that job, it will be many more times because I think the American public likes hearing about the progress that CFPB has made. Thank you. 2010, Congress charged the CFPB with enforcing our mortgage laws so that families would never again face the types of predatory loans and practices that devastated so many communities, destroyed so many people's financial lives in 2018, and did immense damage to the economy as a whole. What would it mean for homeowners in the mortgage market if CFPB didn't have a strong independent structure as Congress intended?
Well,
decade and a half
certainly,
ago?
in as much that the Fifth Circuit's ruling is sustained, it will create major uncertainty in our mortgage markets. It will be difficult to lenders to know what the rules of the road are, and borrowers may not have the clear responsibilities and rights to safeguard them. We learned a hard lesson in the financial crisis when it came to predatory mortgage lending, and the reforms that we put into place have built a lot of resilience in the system.
Thank you. That's why, as you know, I led 35 of my Senate colleagues in filing an amicus brief defending the CFPB's constitutionality, fighting so that CFP continue to create a fair, transparent, and competitive mortgage market, how important that is, protect consumers' biggest financial asset and the key to intergenerational wealth. In 2008, we saw what happens to homeowners. You've said that a number of times in the broader economy when we don't have a strong consumer protection agency. We can't let that happen again, so thank you. Let me talk about medical debt for a moment, Director. 41% of U.S. adults have medical debt. It's clear that accidents and sickness can happen to anyone, young or old, at any time, yet medical debt can affect a person's ability to rent or buy a home. People with medical debt are hounded to pay and are often made to feel like a burden to society. To alleviate the burden of medical debt, Director, would CFPB consider rulemaking to remove all credit debt from credit reports and eliminate deferred interest on medical credit cards?
Well, let me just say that so many people in our country are pushed to pay medical bills that they may not even owe. Many of them have already paid it or are stuck in the loop between the insurance company and their provider, often getting duplicative or conflicting bills. And the concern that the CFPB has is that the credit report may be used as a tool to coerce people into paying something they do not owe. So we are looking at all aspects of the Fair Credit Reporting Act to see whether it is appropriate for credit reports to be used in that way. And we are considering options to restrict some of the parking on credit reports that may be false or inaccurate, because the consequences for individuals are very real. They may fail a background check because of it, even just because they were sick or they had an inaccurate report on their credit report.
Okay, thank you. In November, I wrote to you about the growing number of homeowners suddenly facing threats of foreclosures for second mortgages they didn't even know they had, that they owed. They call them zombie foreclosures. Many of these homeowners haven't heard from their lender in years. Just last week, we found out that some of the companies trying to collect on these debts are actually private equity firms that have targeted single-family homes as a big moneymaker, buying up homes, jacking up rents. Now they're trying to foreclose on homes based on old mortgages. What are you doing to protect consumers from these predatory zombie foreclosures?
Well, so many people got piggyback mortgages. These were 80-20 mortgages where there was a second. Many of them modified it and had not heard and believed that it was satisfied and received representations that they were satisfied. We're now seeing some of those old second mortgages come back, and people are getting across the country foreclosure threats, even though they had already satisfied that. We have issued some guidance to make clear about what the current law expects when it comes to time-barred debt or zombie debt. and we will look to take actions where there's violations of law. This is the type of thing that can really undermine mortgage markets, and we need to make sure it is fair and transparent across the board.
Thank you. Last question. Sunday Magazine, New York Times cover story published a lengthy article just last Sunday describing how consumers desperate to improve their credit scores end up spending billions of dollars on questionable credit repair services. What's the CFPB doing to protect consumers from some of these, from shady credit report outfits that charge consumers big bucks but fail to deliver lasting results?
Well, so much of people's lives are determined by that 3-digit score, that credit score, and people will go to great lengths to fix it. We have taken a number of enforcement actions against outfits that have illegally taken fees and run off, but we need to look more holistically at the credit reporting system so people know how they can fix errors and not be subjected to scam artists.
Thank you. Senator Scott.
Thank you, Mr. Chairman. Thank you, Director Chopra. In my opening statement, I talked a lot about my concerns that you and your agency continue to push enforcement regulations and policymaking through blog posts and speeches rather than through the appropriate Administrative Procedure Act, the process. I'm still very concerned about that, and frankly, this approach not only circumvents Congress, but it takes the public's chance away to comment and provide feedback on the CFPB's proposals. This feedback is critical to ensuring the best policy or rule is put forward and that it works for everyday Americans and Main Street America. Will you commit to refocusing on the CFPB's legislated mission and follow proper APA rulemaking?
So, sir, let me just share that we absolutely do that. And one of the things we hear from small firms is they really want to know how existing law applies. We have so many changes in technology, and these small firms don't have the ability to hire so many lawyers. So I've actually continued a practice of my predecessor, Director Kraninger, to issue these advisory opinions and other guidance documents. They do not create any new obligations. They simply restate what the existing laws are. We receive a lot of good feedback from it. When this policy was proposed, the Consumer Bankers Association, others, really cheered it on because there's a need, especially with the complexity of some of these old rules that have been on the books. How do new business models apply? If we want to promote innovation, if we want to promote new entry, and as you said in your opening statement, if we want competition, we can't have small firms be blocked. And so that's part of why we do this. I understand your concern. If there's specific instances where you feel that was not the case, I take that feedback seriously. And we have proposed and implemented through notice and comment rulemaking so many congressional directives. But I appreciate what you're saying.
Yeah, I'll say it this way. As a small business owner for several years, the one thing I would want from my government is certainty and predictability. I want to be able to go through a normal, typical process, identify my road forward, my path forward, and be able to live by what I think is the normal, typical way of communicating and providing information to the small businesses, the consumers out there, as opposed to using a patchwork quilt of post speeches in order to provide clarifying information to the public. To me, it makes sense that if a business has to rely on the federal government, the one thing we ought to do is do it. There's a process in place to provide that information. I think it's critical that we do it in such a way that the average person can go to the website or through a normal process in order to understand and appreciate what it is that they have to do in order to be a rule follower, so to speak, as opposed to a different way of approaching it.
And we absolutely do that. We try and make our guides also in plain language so that people who are entering a market, they actually can look. And I will tell you, we hear from firms that this is actually saving them money on legal costs. And compared to our other counterparts, we've actually caught up in issuing more of this guidance because I think people want simple ways to understand what their obligations rather than having to follow lots of litigation and deal with lots of uncertainty. So I take what you're saying seriously. I will happily chat with you more about how we can improve that. We do try and put it in one place so that people know really how they can make sure they're living up to consumer rights?
One of the other comments I made during my opening statement had to do with the credit card late fees and the importance of not just lumping them in with the junk fees the president proposes eliminating because he thinks that they're just unnecessary fees. Fact of the matter is that some fees are, as I said in the opening statement, provides discipline, financial discipline, so that when you want a loan for a car, a business, or a mortgage, that you get better rates because the financial discipline that is encouraged through late fees is there. And the question I would ask you is twofold. Number one, the approach of trying to eliminate the credit card fee sounds great because, as I said, no one wants to pay the fee. But the truth of the matter is that that fee is going to be paid just in a different form. If it costs an institution $29 or $38 to collect the fee and you eliminate the fee, you still are going to figure out how to collect that fee, whether it's through increased interest rates or increased cost of products. It doesn't go away. There's this misnomer that somehow the government can just snap its fingers and say the fee is no longer there, but it's embedded in the cost of everything else. So what ultimately happens to small businesses that are starting out, that the entry level, the fee for entry goes up because the government figures out how to squeeze the balloon, but it just creates more pressure somewhere else. And so I hope that you'll take that into consideration. I don't have time for an answer, but I do think it's important that we understand that if you take out a loan, you pay it back. If you don't pay it back on time, there's an incentive to do so or a disincentive not to do so the next time around. Those are really important considerations in a free market economy, that we understand that there is no free lunch. You can't just take away a fee and assume that it's gone. You have to understand that taking away the fee only means that you're going to paint it into the overall structure and cost associated with that institution, whatever it is. Thank you,
Mr. Chairman, may I respond?
Of course.
So our proposal does not seek to eliminate fees.
Right, it just goes down from what it is down significantly.
No, they are fully allowed to capture their costs. And I worry that there's been some misinformation about this. The proposal allows recovery of costs. What it does is it revisits a provision in the rule that the Fed put in a while ago. And we're trying to make that more rigorous and make sure it reflects market realities. And one of the things that our issuers tell us is that they don't want to profit off of late fees. That's exactly the goal here, because the law says those penalty fees are supposed to be reasonable and proportional. We're trying to make it more clear about the way we can do that while also making the market more competitive.
Just final comment. Thank you, Mr. Chairman. I think you're one of the best witnesses that says a lot in a very effective way, but somehow we get off course, because the truth is that if you study the actual cost of collecting on these late fees, if we just go with whatever that cost is of doing business, that'd be great, but the proposals that I've seen reflects a significant drop in the fee that actually does not cover the cost of the collection. But we could do this all day.
Yeah, that's not right.
I'd rather us have a serious conversation.
Senator Menendez is recognized.
Thank you,
Thank you,
Chairman. Wells Fargo is an exemplary institution. That is, that it has exemplified why we need the CFPB through flagrant and persistent issues impacting its consumers. From the fake account scandal in 2016 to the $3.7 billion penalty the Bureau assessed on Wells Fargo last December for, quote, widespread mismanagement of auto loans, mortgages, and deposit accounts, the CFPB has repeatedly stepped in and stepped up to protect consumers from harmful schemes at Wells Fargo and other institutions. So, Director Chopra, if the CFPB were defunded, as many Republicans in Congress would like it to be, who would be responsible for protecting consumers from this type of abuse?
I don't believe there'd be anyone if we were simply defunded.
And that's their answer, nobody, which is why we created the CFPB in the first place and why I joined 36 of my colleagues in an amicus brief defending the CFPB. A strong, independently funded CFPB is essential to protecting consumers from harmful practices like we've seen at Wells Fargo, $3.6 billion. Now, I continue to hear stories from New Jerseyans who have fallen victim to scams and fraud on Zelle, and other peer-to-peer payment apps and have been unable to obtain relief from their banks. The last time you came before this committee, we spoke about this, and you indicated that you were hoping that the industry would set up frameworks to combat fraud and scams. I haven't seen much progress. Well, what progress, if any, have you seen from the industry in ensuring consumers are made whole when they are scammed on peer-to-peer payment platforms?
Well, the industry manages the ACH network. They vote through the NACHA process. They have been very slow to take action. They need to speed up with respect to services like Venmo, Zelle, others. They may have different processes. We are making very clear that we need to make sure that the law is being followed, but also that they take responsibility for updating rules that they control. If not, we're going to continue to have more scams. And in this digital environment with generative AI, voice cloning, it could get even worse.
Well, from my perspective, it's been over 6 months since it was reported that banks that own and operate Zelle were considering requirements to reimburse customers that fall victim to scams, but nothing has been finalized. And when consumers are being harmed, and industry is unable or unwilling to address the problem, the CFPB needs to step up. So I hope that at some point, we're just not going to keep giving time to the industry to do that, which I think they don't really want to do. I'd like to believe they want to do it, but at this point, they have the wherewithal, they have the capacity, they have the resources to figure out what are the tools necessary. And I hope the CFPB will use all the tools at its disposal, up to and including modernizing Regulation E to reflect the reality of growing use of apps like Zelle. I have some significant concerns about the potential impact that restart in student loan payments will have on student loan borrowers. Research from your entity shows that an increasing number of student loan borrowers are delinquent on other credit products. Borrowers will likely also be impacted by changes to the system since the pause began. In the past few years, several student loan services have exited the program, and as a result, 17 million student loan accounts have been reassigned to other loan services or other servicing platforms. What is the CFPB doing to facilitate a smooth transition for borrowers back to repayment?
It will be very difficult. Many people may have moved. Many people are with a new servicer. In some circumstances, they will need to re-up their auto debit. We are working hard with the Department of Education. They are facing serious budgetary constraints in making sure they can effectively communicate and collect. But of course, we're working with the states and other federal agencies as well to make sure that loan servicers and collectors are adhering to existing law. If we do not get this right, we will have a surge of delinquency in our country, which could have long-term effects. And we are actively working to make sure we mitigate that
That's what I
harm.
hope we are working to prevent. Finally, the CFPB's complaint system is critical to the operations of the Bureau, given its real-time reports into potentially deceptive or abusive financial practices. However, for consumers with limited English proficiency, the complaint system as it currently exists remains out of reach. While there is a Spanish language complaint system by phone, there is no CFPB online complaint system in Spanish or, for that fact, any other language. According to the 2017 American Community Survey, nearly 26 million people, nearly 10% of the U.S. population, have limited English proficiency. Consumers who lack access to information are prime targets for predatory behavior. Why is there currently a complaint system, why is there not currently a complaint system online in Spanish or any other language? And can you commit today to try to make the complaint system available in an additional language?
Mr. Chairman, may I answer? Mr. Chairman, may I answer?
Of course.
So one of the things we have to consider in that is we transfer the complaints to the financial institution. So we would need to think about, would we translate that or do something different? I am looking into expanding language access across the board. We have actually done some specific research in recent months on speakers of 6 different languages. I'm happy to figure out ways in which we can make sure more individuals who speak Spanish and other languages are able to access our system.
I could just say to you, Director, there are some pretty sophisticated programs that can auto-translate in a way that would be sufficient for the institutions to understand what the challenges are.
Senator Brett from Alabama is recognized.
Thank you, Mr. Chairman. Mr. Director, thank you for being here today. Greatly appreciate it. I want to follow up on a line of questioning from my colleague, particularly given the rise in AI. As you mentioned, if we are not thinking about the way that tech and AI affects the banking industry in a number of ways, we're not all doing our job. One of the things that I am really concerned about, and I think we can both agree, rewind, I think we can both agree that, or assume that obviously we need to go after bank robbers. And now in this day and age, thankfully, you don't see as many of those things in actuality, but what we do see is fraud to consumers. So we're seeing it across our state. We had a number of people targeted through the use of AI and unfortunate scams, so to speak. And so when I look at your budgetary proposal, when I look at your performance plan, it shows that consumer education initiatives are decreasing at the CFPB. And I want you to help me understand why the CFPB's investment in consumer education is not projected to keep pace with the rise in fraud and scams that American consumers are experiencing. I think we have to make sure we're doing our part to make sure that Americans are protected.
I'm in total agreement. I think we need to make sure this committee, too, is on notice about generative AI, voice cloning,
Right.
impersonation.
Yes.
One of the things I took a look at in our budget is I found that there was a lot of programs that may have needed, that were not effective. So I'm very open to finding ways that have some empirical effectiveness, but in the age of AI, pamphlets won't be what solves it. We're looking at digital literacy tools, ways in which consumers can protect themselves. Spot scams, we're also looking at how it could be focused on specific populations. Service members are much more likely to be targets of these scams and identity theft. Older Americans face different issues, so I'm
Absolutely.
open
and
to
so
all.
I think when I see the decrease in the budgetary items, it concerns me because Alabamians alone lost $55 million last year to scams. So we need to be making sure we're doing what we need to be doing to staying in front of that, to educating people about what you just said, AI and the use of voiceovers and all of the things. So thank you. I look forward to working with you on that. I also think that our emphasis needs to be placed on places like that where we're really protecting consumers instead of what we've seen this administration talk about with regards to actual incentive fees for people to pay things on time. My question to you is, how many comments did the Bureau receive on the proposed actions related to the quote unquote, as you put them, junk fees?
I don't know the exact number. I want to say it's in the tens of thousands.
Yes, I believe it was 60,000 is my understanding. So, I mean, that is a significant number. And I just want to make sure that you're committed to taking time to really reviewing those and the implications of those from various people.
Oh, absolutely. And I just want to comment real quick. It is important that people have the appropriate incentives to repay. I think we want to make sure what we learned, and I think Senator Scott mentioned in his opening, consumers face a lot of consequences when they
Absolutely.
don't pay. Credit scores getting harmed. They might face higher prices, but we want to make sure it's fair and competitive, and I will commit to you, we will carefully review
And do you
all
have a
of the
timeline
comments
for
in the
that yet
record.
on how long you?
So the docket you mentioned, that did not have a specific
Okay.
proposal attached to
Okay.
it. That was more inviting broader comment. But as it relates to specific rulemaking proposals, I don't know if you have a specific one in mind. We're trying to do it in a way that is rigorous, but that does not take forever.
Okay, and then I know I'm running out of time and I actually have two more things I want to touch on. But when we hear from some of my colleagues about the removal of medical debt completely, do you not agree that excluding accurate information on ability to repay factors will affect a bank's decision? It could have a detrimental downstream effect if you were to remove an entire source of information from a bank.
Well, the word you said is accurate is important.
Right.
And some of the analyses we have seen from the industry is that it is not necessarily predictive
Right, and
of
I do
other.
I do appreciate what you said earlier about if someone is involved in being attacked from two different sides, and that we've got to figure that out. We want to make sure that we are putting people in the best position possible to succeed. But eliminating an entire group with regards to medical debt completely, you then wonder what would your opinion be on what would someone's incentive to pay that debt be if it was completely removed?
Yeah, and I take that very seriously, and I think the accuracy issue is what I think is really the lodestar. Again, the credit report, it's not supposed to be a place where you part rumors or where you put something in order to say, make them pay even if they don't owe. That's really the sweet spot we're trying to hit at.
And as I close, I would just like to say, when we look at 1071, I hope that you really consider the effects on small, mainstream, Main Street banks, relationship building banking that we see. I mean, we've got a lot of people that are making our small communities thrive, and I think they need to be heard, and you have the ability under 1033 to give the exemption, and I really hope that you take a look. We need our community banks and our financial institutions and our farm credit bureaus to thrive, and they're doing a good job, and if they have a CRA rating of outstanding or satisfactory, I mean, these men and women are trying to make their communities as healthy as possible, and I hope you will consider giving them an exemption.
And those
Thank you.
small banks performed disproportionately well during PPP.
Absolutely, they
And
did.
based on our adjustments to the rulemaking, there are a substantial number of banks, even in Alabama, who will be exempt now. But
Well,
I take
I
that.
Thank you,
look forward to
Director.
that. Thank you.
Senator Tillis of North Carolina is recognized.
Thank you, Mr. Chairman. Mr. Chopra, thank you for being here. Is CFPB a prudential regulator?
No, we do not, in the typical sense, we do not do safety and soundness, capital adequacy type work. Our focus is
Yep.
in federal consumer financial.
Does the CFPB consult with prudential regulators when taking actions that may impact safety and soundness?
Yes, so we are in regular touch with them, particularly when it's entities that we jointly supervise. We've actually done more of those actions in concert with them with respect to any regulation. We closely consult them on all of that because the last thing we want to see is any threats, to the system.
I know the CFPB has campaigned against the so-called junk fees, which I believe is an expansive term covering fees associated with a variety of financial products. This includes overdraft fees. In 2008, after the 2008 financial crisis, some regulators under the Obama administration emphasized the reliability and countercyclical nature of overdraft revenue as an appropriate tool for ensuring the stability of the bank's balance sheets. What specific, I should go on to say, some at the Federal Reserve went so far as to express desire to see overdraft revenue when grading banks on the well-known CAMELS rating system. So what specific instances of consultation has the CFPB engaged in on overdraft fees, given these fees have previously been used to justify critical safety and soundness ratings?
Well, as a general matter, non-interest income is something that a prudential regulator looks at to determine where might there be cyclicality, where might there be ways in which they can ensure adequate earnings. There's no question of that. Both the FDIC and the OCC have now published more and more guidance with respect to different fee streams, including overdraft fees. So certainly the place where we've been looking.
Can you give me some specifics on the consultations?
Well, they have issued guidance in many ways as a result of all of the work we have done together. We work with them on data. We work with them to see what might the impact be on the system. We work with them to see how might this affect banking access. There's all sorts of ways in which we dialogue with each other, and it has been very high on their list as well to address potentially overdraft fees where 3 are charged instead of 1. And I think that's where a big change has occurred in the market.
What analysis has the CFPB conducted in its efforts to discourage overdraft fee revenue and that interaction with safety and soundness and balance sheet stability?
Sorry, what analysis has the CFPB conducted? So we have
To discourage overdraft fees.
So Again, it's not necessarily discouraging, it's making them appropriate and competitive. So what we are seeing in the marketplace right now is actually a shift to more overdraft lines of credit. So in many ways, this is giving people a new way for credit creation, a new way to capture revenue. The analysis that's specific to institutions on their safety and soundness or the system, that's really done by the prudential regulator supervisor for that institution in developing any rating.
I want to talk, I'm going to submit some questions for the record on this line of questioning, but in my limited time, I'm also concerned with the level of rigor that went into the $8 late fee proposal. It looks like your data doesn't account for the actual cost incurred by banks to actually manage these accounts. So if banks aren't able to cover their full cost, won't that lead to driving up prices for consumers who will continue to be banked?
So just to be clear, we have not proposed a $8 cap. They are able to recover their costs. We actually put more rigor.
I think
into
more
the
the
proposal.
more fundamental question is that if these accounts cost more than the revenue stream to sustain them, how do they make it up? They make it up one of two ways, right? They don't bank with a given customer, or they find a way to get the revenue to cover a cost of basically a losing proposition. So it seems like we're still moving down a path where we're going to artificially cap what you may need to actually justify even having that business relationship. What am I missing?
Well, the law prohibits using penalties as a major profit center. That was in the law. We are reviewing the Fed's rule on this to make sure
But
that
I'm just talking about having a revenue
realities.
stream to cover the underlying cost of a given account. That's what I'm just.
I understand. The law is clear, though, that it must be reasonable and proportional to the violation or omission. That's exactly what we're trying to make sure is held faithful. Sorry.
We'll submit other questions for the record. Thank you, Mr. Chair.
Thank you, sir.
Senator Warren of Massachusetts is recognized.
Thank you, Mr. Chairman. So each year, credit card companies squeeze billions of dollars in fees out of American consumers. And chief among these are the late fees that you were just discussing. The $20 or $30 or $40 that credit card issuers charge customers whenever they're late on a payment. Now, some banks demand these fees even if someone is late only by a few hours, or even if the missed payment is actually less than the late fee itself. These fees cost families an estimated $12 billion a year, and earlier this year, the CFPB proposed a rule to put a cap on unreasonable fees. No surprise, the bank lobby is unhappy by this and about this. And in response to the CFPB's rule, the big banks and the credit card issuers have unleashed a massive public relations campaign claiming that ending $40 late fees would end credit cards as we know them. So I thought I'd use my time today to talk just a little bit more about this proposed rule. So Director Chopra, does the CFPB's proposed rule ban credit card companies from charging late fees?
No, absolutely not.
Okay, so it's not an end to late fees. The rule just lowers the maximum amount the credit card companies can charge while getting automatic immunity from enforcement actions. And that dollar figure right now is proposed at $8. So let me ask this. If a bank needs to charge more than $8 to cover the actual costs of collecting missed payments, would the proposed rule permit that?
Yes. They will just have to calculate it.
Okay. So they can charge more if that's what it costs to actually cover the services. Is that right?
That's right.
Okay, that sounds pretty reasonable to me. So if the banks want to charge more than $8, just come and show your math about why you're charging more than $8, and there's not going to be any problem here. But it's clear that the big banks aren't interested in being reasonable under these circumstances. They insist that this rule would force them to pass on costs to all the rest of their customers or stop issuing credit to lower income families. So let me ask this. Director Chopra, do you know what percentage of revenue late fees represent for the largest credit card issuers?
I don't know, but I don't believe it's very large.
Okay. When I asked the biggest credit card issuers for this information, their response was that it was less than 1%. It was only a fraction of 1%. So if there's an $8 cap on credit card late fees, unless the banks can show that their costs are higher, in which case they can charge more, all that will happen, as best I can tell, is that the banks will have slightly lower profit margins. Does that sound about right?
Well, the law specifies actually it's not really supposed to be a profit center. So
they don't get to make a profit in that sense on people who are late. They can certainly cover their costs, but it's not supposed to be a profit center. And that's not the decision of the CFPB. Say that again?
yes,
Why is
that's
that so?
that's in the Card Act. The Card Act specifically prohibits fees that are not reasonable or proportional. And the fact that you can be charged a massive fee for being a few hours or a day late by a few dollars, that doesn't appear to be proportional.
Okay, and the Card Act, as I recall, was passed even before the CFPB
That's correct.
came into existence here. So look, the CFPB is helping root out junk fees. And because of that, Americans are going to keep a little bit more money in their pockets. I think of this like the $35 insulin, like student loan debt cancellation. Getting rid of junk fees is one more example of putting government on the side of the American people. You know, junk fees is just one reason why it is critical that we have a CFPB, and that is why I have joined my colleagues in signing the amicus brief supporting the CFPB against attacks that undermine the Bureau's ability to fight on behalf of families. I'm grateful that you're there waging this fight, and I hope you keep it up. Thank you. Thank you, Mr. Chairman.
Senator Daines is recognized from Montana.
Chairman, thank you. Dr. Chopra, thanks for being here today. In your testimony, you highlighted the impact of increased interest rates, what effect they're having on families. I will tell you, I hear that as I travel around the state of Montana. I remember being in this very room, whether there was a banking hearing discussion or as part of the finance committee in another room, when we had this fight about, is it smart, is it the right thing to unleash another nearly $2 trillion into the economy in terms of stimulus. We had $1 trillion of unspent dollars at the end of 2020. And there was a word that kept coming up, no, inflation is transitory, it's transitory. I don't hear the word transitory coming from anybody anymore, from the administration or from my colleagues across the aisle. We warned the American people, we warned our colleagues this was going to create inflationary fires, and lo and behold, it did. Injecting trillions of dollars of unnecessary stimulus in the economy was a significant driver of seeing now 40-year highs in inflation and requiring now the Fed to increase rates, and hardworking Montanans are paying a severe price for that. Director Chopra, CFPB's small business data collection rule is something I've raised with you previously. Now, I've heard concerns from financial institutions across my state, smaller institutions, larger institutions, about how unworkable this rule is. The Bank of Bridger, bank that has jurisdiction and branches around Montana and in Wyoming, its chief credit officer said this is the most intrusive rule he has seen in his entire career. And I can tell you some of these smaller banks, their compliance department is not on the 22nd floor on Wall Street. These are small banks. He says it's the most intrusive rule he's seen in his career, and he's rightly concerned with what your agency is doing with this data. I have major concerns with the rule overall. I'm particularly, though, concerned about this 18-month implementation deadline, given that in the past, a complex rule like this has deadlines of more like 24 months or greater. Given this is such a complex rule to implement, in some cases, new systems are going to have to be created, will you consider extending that deadline beyond 18 months?
So I appreciate what you're saying here. This is obviously a congressional mandate. We were under a court order to complete it by March 31st. With respect to the implementation timeline, it's not just 18 months. 18 months is only for the very largest lenders. So we gave quite a bit of additional time for the smallest ones and actually exempted a few thousand of them. But I hear you.
Remember where
on-
you drew that line at in terms of small? Do you recall what that is?
Yeah, so we took a look at I'm sorry, there's a little echo here. Took a look at the overall contours, and the way it was built was roughly 2,500 loans, so a much smaller subset of local banks and credit unions.
And
mostly
that
the
deadline goes
largest
out how
ones.
far then for the smaller institutions?
Sorry?
And how far was that deadline extended? Into 18?
I need to think of I believe it was an additional 15 months beyond that. I don't have the exact name, but it was beyond 24 months, I believe.
Okay, we'll follow up. Thank you.
Okay.
On March 15th, your agency put out a RFI on the privacy and security risk of data brokers. Ironically, just 6 days later, on March 21st, the CFPB notified Congress of, quote, a major incident regarding a data release of over 250,000 consumers' personal information. It is reported that CFPB learned of the breach on February 14th. Maybe you can confirm that for us. But it took you more than a month to notify Congress. Here, the agency that's trying to regulate the safety of consumer data itself can't adhere to the controls you're trying to implement on others. I think that's unacceptable. Why did it take more than a month, if I have my facts correct, and correct me if I'm wrong, for you to notify Congress of a major breach?
So the insider threat issue is very, very serious, and we have been briefing your staffs on this. We identified an indicia that there was suspicious activity by a now former employee. It took us a few weeks to look and determine whether there was any impacts of that. We did find a situation, while there was no account numbers or social security numbers, we followed all of the OMB guidance to make sure that Congress was aware, and we followed all protocols. You're right, though. We have to make sure that not just our systems are impenetrable, but that we make sure that insider threats are detected
What
and
happened?
stopped.
What happened to the insider that you detected? What happened to that person?
I'm prohibited from commenting in detail, but I will share that they are a former employee now.
Senator Cortez Masto from Nevada is recognized.
Thank you, Mr. Chairman. Director, it's good to see you. We know that from our past work and our current work that individual consumers are quite often mismatched in fights with financial firms over unfair and deceptive practices. That's why the work of the Consumer Financial Protection Bureau is so important. I also think that your actions to fight junk fees, illegal overdraft fees, and discrimination is critical to all of our priorities, and it should be to help people keep more of their money at the end of the day. So to ensure the Bureau is able to continue to protect people from unfair fees, that's why I joined the 35 of my Senate colleagues in an amicus brief defending the Bureau's funding structure as constitutional. I think it is so important. Let me talk to you a little bit about our small businesses and particularly franchising. I so appreciate the work that you're doing to stop unfair and discriminatory lending practices to business owners, and I support your efforts to really track small business lending and protect entrepreneurs investing in franchise businesses. So just can you explain how the Bureau is protecting those businesses from the unfair, deceptive, abusive, and sometimes discriminatory financial practices?
Well, franchisees are really one of the lifebloods of really starting business in America. People, you don't necessarily need a lot of connections or huge amounts of wealth to start it. And across the country, rural, urban, everything in between, it's big. We are trying to make sure that we're enforcing all the laws that protect those small business owners. We're working with the Federal Trade Commission and other regulators. I don't want to see a world where small businesses, and especially these franchisees who went through so much during the pandemic, are not able to access capital fairly or really protect themselves and their data. And many of them are now getting business credit reports So we're working with those with the relevant authority to make sure they're safe and secure.
And thank you. And we will continue in my office to work as well with you or to bring forward the concerns that we hear from some of our franchisees, these businesses. Not all of them, right? Some of them work really well, but there are some that are taken advantage of. So thank you for that work. Let me jump back to our service members. In 2021, service members and their families submitted more than 42,000 complaints to the Consumer Bureau. The most common type of complaint, more than, I want to say 60%, were about credit reporting and debt collection. And service members have complained to the Bureau about billing inaccuracies as well. They also say that some debt collectors use aggressive tactics to recover allegedly unpaid medical bills. How is the Bureau working to protect service members and their families from unfair and really some of these expansive practices? And how does the Bureau ensure that these lenders are complying with the Service Members Civil Relief Act?
It's a great question. So we've taken just over the past, I think, 15 months, several actions specifically related to service members, their families, and veterans. We enforce the Military Lending Act aggressively. We make sure that the provisions are adhered to. But I will say that these credit reports is still a major pain point. Many military families, they have to move due to PCS orders frequently. Mm-hmm. This creates issues with their credit report, and when they have an inaccuracy, it can even have implications for their own careers. We see firms needing to make sure that they're treating those individuals fairly. The Service Members Civil Relief Act, we did a report that looks at how Guard and Reserve, when they're activated, are they getting their SCRA benefits? And we're finding pretty low uptick on that. We're working with the Justice Department and others to make sure the SCRA, which prohibits foreclosures, auto repos without a court order, the Military Lending Act limits interest. We want to make sure everyone is following that faithfully.
Thank you. And whatever we can do to continue to support that work for our service members is essential. You talked about credit reports because I think the Bureau, and if you would talk a little bit about this, you're working to ensure that there's accurate credit reporting happening when it comes to medical debt for families. Is that correct? Because
Yes.
I'm hearing from Nevadans as well that this is starting to clear up for them and help them to address what they're seeing with some of this medical debt in their credit reports.
Yeah, so sometimes people will go for a lab test. They'll get a bill from the facility, a bill from the provider. Sometimes they're faced with multiple deductibles for the same service. They're trying their best to get it resolved, but often it gets put on the credit report and they feel almost threatened to repay. And actually, many of them do, even though they don't owe it. We have to really fix this on credit reports.
And thank you for your work there. Thank you, Mr. Chairman.
Thanks, Senator Cortez. Now, Senator Kennedy from Louisiana is recognized.
Thank you, Mr. Chairman. Thank you, Mr. Chopra, for being here. You just had a data breach at your agency, is that correct?
We have an insider threat that transferred on an unauthorized basis some emails to their personal email
All right,
account.
and you were in charge when this happened? Is
Of
that
course,
correct?
yes.
Okay. And this wasn't an attack from outside your agency. It came from inside of your agency. Is that correct?
That's right. Our systems were not penetrated. It was not a hack in that way,
Right.
but we had an employee who worked for
Well,
us
did-
who
did-
sent those emails.
The data for 256,000 consumers was breached. Is that correct?
Yeah, we looked through
But
the
is my number
emails.
correct?
I believe that's right. Yes, but it was not their. It was not any social security number, birth dates, any of
It
that.
was their data, though, right?
It was the institution's data, but it had their name, so that's important, and it's a huge problem.
Yeah, it is. You didn't tell the customers that this happened to, the consumers, for 2 months. Is that correct?
Well, we did not have the contact information for them, so we had to work with institutions to figure out who to contact, and we wanted to work in partnership.
But you
with
didn't
them.
tell them for 2 months?
Well,
Is that correct?
we started the notifications, I believe, last month, but again, we did not know the contact information for
Right.
them. All we had was certain data elements, and we followed the cybersecurity OMB guidance to make sure
Well,
that
you can understand, can you not, why consumers might be a little concerned about you having their information. Is that correct?
Oh, of course, the issue of
Let me ask you this.
protecting
Let me
personal
ask you
data.
about Section 1071, your rule on small business data collection. Under your proposed rule, when a bank loans money to a small businesswoman or a small businessman, the bank, you would require the bank to ask that customer first about the customer's race. Is that right?
So, just to be clear, the proposal you reference, that has been changed since and has now into the final. The congressional requirement, and we are under a court order, requires
Don't
race.
filibuster me, Mr.
No, it does
Chopra.
require
Just
race.
answer my questions, okay? Is your rule going to require banks to ask the customer about their race,
So that is
Yes
in
or
this
no?
that is in the statute, and
about their race, or is your rule going to require the bank to ask the customer about their ethnicity?
so just to be clear, in the sample form, it allows the borrower to self-identify or refuse.
Just answer my question.
No, I'm trying to be clear.
No, you're not. No, you're not. Your rule would require a bank to ask the question of a small business person, what's your race? What's your ethnicity? What's your sexual preference? Are you gay? Are you a woman? Now that's you can bubble wrap this all you want, but that's what your rule does. Now the customer, particularly in a small town, is going to go, whoa, what's my sexual preference have to do with a loan? And the customer can say, I don't want to answer. But then the bank you're requiring the bank to tell you that they wouldn't answer. And all of this data is going to go to your agency. And we don't have the slightest idea how you're going to use it, except you say you're going to publish it.
Well, we will not get any names at all.
But you're going to have data sets so that if it's possible. You can't tell me it's not possible to have this information known. Why do you want all this information?
I don't.
Why do you want to know what a small business woman's sexual preference is?
Okay, that's a mischaracterization.
No, it's not.
Of it. Yeah, it is. We
No,
have
it's not.
congressional objectives.
No, it's
We
not.
had to implement it. People can self-identify. There is no personal
Why do you
information.
want to know what a small business woman, let's say in a town of 20,000 people, going to her local bank to borrow money? Why do you want to know what her sexual preference is? What business is that of yours?
We sought to implement what the
What
congressional
business is
requirements
that of
are.
yours? What a small businesswoman does in her bedroom? Who
Again,
appointed you Pope?
again, people are able to self-identify if they wish
You're
to
making
refuse, they
them.
can. We are not making them.
Yes, you are.
No, we're not.
And
It's
if they
very
don't
clearly-
answer, the bank has got to tell you, and we have no idea how you're going to use this information.
Well, I'm
You
out of
can't-
time. I'm happy to
Director
meet with you
Chopra,
about it further.
Director
That's
Chopra.
not, I don't believe that's an
Director
accurate.
can't
Chopra, please.
assure us-
Senator Kennedy, Director Chopra, answer one more time, and then I turn it to Senator Warner, who is on.
Am I
Just
over,
like
am I over again?
Yeah, you're way over again, and I always let you, but I'm not going to let you go 3 minutes over with the same question 8 times, Senator.
Well, if
Director
you'd
Chopra.
answer it,
So
I
Director
just like the Home Mortgage Disclosure Act, there's other ways where there's requirements from Congress to collect data. In this situation, we took a lot of feedback to try and make it less intrusive, specifically based on the concern you're raising. There will not be individual consumer names sent. We can talk further about it, but we tried our best to implement the congressional directive faithfully and consider all of these issues.
Senator Warner from Virginia is recognized online.
Thank you, Mr. Chairman, and thank you for holding this hearing. I mean, I was around when we set up the CFPB. A lot of this was due to the fact of abuse of consumers, and frankly, a lot of it was sometimes in the case of making sure that our financial institutions did not discriminate against any group of Americans. And I think individuals' identities obviously need to be protected, but I think patterns of behavior, particularly if they lead to discrimination, I think are relevant. I would point out, as somebody who signed the onto the amicus brief, that some of our friends who are trying to defund the CFPB, I would point out that a group of business organizations I've worked closely with over the years, the mortgage bankers, the home builders, the realtors, have actually said that if the court were to somehow invalidate all of the CFPB regulations, and they've not always loved everything the CFPB has done, but if the court were to take that action, it would throw the whole housing market into chaos and to the detriment of all mortgage borrowers. So I hope that court case is not successful. Director Chopra, one of the things that I've been spending a lot of time on is, and as chairman of the Intelligence Committee, is and something I think we're all racing to understand, is artificial intelligence. I think we've had a half dozen sessions already with different groups of senators on this issue. I think Senator Britt raised the issue a little bit earlier. I do believe that we cannot repeat in AI what we did in social media and say, well, let's let this whole world evolve and then we'll come in and try to fix it after the fact. Congress's track record on social media has been a complete zero. And I'm glad to see there's concerns on a bipartisan basis on this, but our record of getting stuff done on these large platforms is pretty poor. I think Senator Brett, my understanding, raised some of the issues about consumer abuse. I guess one of the things, and this indirectly at least goes back to some of the questions that my friend Senator Kennedy was asking. We've already seen as data into these large language models, everybody's talking about ChatGPT, but there's the ability to have these algorithms literally discriminate against consumers in the financial services sector. So can you talk a little more about your concerns about AI, specifically what the Bureau is doing about this potential discrimination that may be coming very deep into the algorithms that are going to be, frankly, we don't have much transparency on out of these large language models? What might happen if suddenly a consumer was not only discriminated against, but also then pointed to a product that might not be good for them? I know our time's running down, so I'll turn it over to you. And do you need more regulatory tools? Do you have the tools you need? Because there's a lot of us trying to figure out where there needs to be these guardrails. But I think you've got some of the tools already in place.
So there's no question that as large tech firms, others enter the financial space where they already are ingesting enormous amounts of data to feed some of these artificial intelligence models, combined with the fact that generative AI, including the creation of voices and content, I think it creates a situation where if we don't use the laws we have on the books today effectively, we will see a faster uptick in fraud, we will see more exclusion or discrimination, and frankly, less accuracy in the system when it comes to home appraisals and so much more. So we have put into place, Senator, a set of guidance to make sure people know this is how, if you're using AI, how the existing law applies. If big tech firms continue to have a bigger footprint in payments, and they are using that payments data, our most sensitive data, to feed their AI, I think that also raises a whole slew of questions about personalized pricing and ways in which people may not have the advantages of the normal consumer protections. Senator, I'm out of time. We will work with you to figure out what additional tools are needed Certainly, there's issues around identity verification and more, but there's no question this committee and the CFPB, we have to focus on how big tech and AI will transform banking.
Thank you, Mr. Chairman.
Thank you, Senator Warner. Senator Vance from Ohio is recognized.
Thank you, Mr. Chair, and thanks, Mr. Chopra, for being here. I want to talk just a little bit about the SVB collapse, and particularly the way in which the San Francisco Fed failed to successfully address that situation. So, just sort of ask on the three major bank failures we've had this year, Mr. Chopra: First Republic, SVB, and Signature. Who were the primary regulators of the three banks?
So the Federal Reserve of Silicon Valley Bank at the federal level, the FDIC at Signature Bank and First Republic. Two were California state chartered banks. One was New York.
Okay, thank you. So one question is, do you know the last time an OCC regulated bank failed?
A large one, I believe, has not failed in some time.
Yeah, so I think the last one was 2019. It was a pretty small bank, didn't require some of the extraordinary measures that you guys took in response to the SVB and First Republic collapse. So here's, I guess, my basic question here. I've heard this from industry people, and you always have to be somewhat skeptical when you're talking to industry people. Obviously, they have their own self-interest, but on this issue, I think they're clearly right, that the Fed is both an overburdensome regulator, but also a very ineffective regulator, that they take up a lot of time and don't actually do a whole lot to make the banking system safe. I'm wondering if you have a view on that. Is the OCC a better regulator than the Federal Reserve? Maybe I'll just ask that question directly and sort of get your view there.
I think it depends. It's hard to say overall, but I will tell you, I think if we were starting from scratch, we probably would not create this balkanized system of who's accountable for oversight. From my viewpoint, as having backup supervision on consumer for all types of banks, including large banks and others, as well as from the FDIC board, I do think inconsistency and supervisory approach, does have costs.
Yeah. So I guess the question that I have is, given what you just said, and I agree with you, if we were to create this system fresh, we probably wouldn't design it in the way that it looks now. This is sort of some combination of bureaucratic capture and the various ways in which we reform the system over time. Could you speak to the potential efficacy of moving part or even all of the Fed's supervisory power over to the OCC?
So the last experiment we had with this was really the CFPB. The Fed's authorities were largely stripped on consumer, and I think we've actually created, maybe not everyone likes it, but a huge amount of consistency throughout the board. So I think we would, if you wanted to create consistency, there's many ways to do that, but I don't have deep insight onto the Fed's supervision on the prudential banking side. But inconsistency is not good.
Yeah. So we're going to look into potentially some legislative changes here that I think would make the banking system both more safe and lower risk for consumers and taxpayers, but also would actually be more efficient from the perspective of industry. I really worry here that we've somehow created a system that is both overly burdensome on the financial institutions, including and especially those that are doing the right thing, and is simultaneously really, really ineffective at preventing systemic risk. We'll certainly have more questions and more conversations in the weeks and months to come as we develop that policy. I want to close by just making an observation, and feel free to respond, though I recognize we're getting down on time here, Mr. Chopra. You said at let me get the organization, I think it's the American Economic Liberties Project, in a speech on May 4th, that you were really concerned about concentration and bigness in the financial sector. And I think probably more than many of my colleagues, I share that concern about bigness in the financial sector. But I do have some concerns that the actual policies of the last couple of years have heightened that problem, not lessened it. In particular, we of course, as I understand it, there was a bidding process for First Republic. PNC, much smaller bank, still a large financial institution, but a much smaller bank, and JP Morgan both submitted bids. And of course, JP Morgan's bid was accepted. My understanding is that increased JP Morgan's depositor base by, if you combine everything that's happened in the last year, by close to $100 billion. That strikes me as a really bad deal for consumers, a really bad deal for the risk of our financial system, but a really good deal for JP Morgan. And so as you guys go about your work over the next couple of years, and certainly as we go about ours, I would love for us to pursue policies that actually preserve and strengthen the three-tiered banking system rather than make JP Morgan more and more powerful, which is what it seems that we're doing right now.
And certainly many banks personally raise concerns that it seems obvious that we have a lot of too big to fail banks, and guess what?
Right.
They get a funding advantage from that in terms of lower costs of capital, and that has the result of really threatening local banking.
Yeah, and I agree with that, Mr. Chopra. And Mr. Chairman, if I may, just one brief addition there. One of the things that I hear pretty consistently, and Ohio has three very, very significant banks, but small compared to JP Morgan. One of the things I consistently hear from folks back in Ohio is this fear that federal regulators in some ways treat the regional banks the same way they treat the big banks, even though the big banks have an implied lower cost of capital, because everybody knows that JP Morgan is going to get bailed out. But is it true that Huntington is going to get that bailout? Maybe, but maybe not. And that problem is, I think, really, really bad for the banking system that we have. I won't rehash the ways in which the Huntingtons of the world will make loans to businesses and consumers that JP Morgan won't touch. So I want to work to preserve that system, and I'll work with whoever is willing to work with me on that. Mr. Chairman, I yield. Thank you.
Senator Van Hollen of Maryland is recognized.
Thank you, Mr. Chairman. Director Chopra, good to have you here. Thank you and your team for your leadership. The CFPB plays an essential role in defending American consumers against some powerful financial interests that want to take advantage of consumers, especially those that engage in practices that essentially separate consumers from their money without giving them any additional value. You, of course, the Bureau has become a target of those interests and have filed a lawsuit to try to put you out of business, which, as you know, is pending before the courts. I'm proud to have joined the chairman of the committee, Senator Brown, and others in filing the amicus brief in that case to make sure that you can continue to protect American consumers. I've long been a supporter of the FedNow system because I think that folks who are living paycheck to paycheck, wage earners should be able to get immediate real-time access to their money, so they're less subject to payday lenders and less subject to overdraft fees, which you have worked to also cut down on. I'm also have introduced the Opt-in Act, which makes it harder for companies to convert free trial periods into paid subscriptions without consumers' consents. That particular bill is outside of your jurisdiction. But since we're facing this moment in the courts, could you just provide a high-level sort of estimate of, if you look at all the areas under your jurisdiction where you're trying to crack down on various schemes that unfairly hurt consumers, do you have a sort of ballpark estimate as you look across your jurisdiction of what goal you're working to try to save consumers money in dollar terms?
Well, it's been billions of dollars just in the past year alone. The CFPB, I believe, has collected over $17 billion just in a subset of its work. But let me share with you this. When we let bad actors violate the law, it's not just consumers that get hurt. It's every firm that is trying to play by the rules. They get disadvantaged too. And I think we always need to remember the people who get hurt are not just the homeowners, not just the borrowers, but it's the businesses that are following the law. And rule of law in our financial marketplace is imperative, and it's why we take our responsibilities so seriously and why money in people's pockets, it was theirs to begin with.
I appreciate that. As you say, there's that dual benefit. $17 billion in just one sector over 1 year obviously illustrates how important your work is to defending consumers. And if you don't have a cop on the beat who is trying to make sure everybody plays by the rules, as you say, it actually creates an incentive to a race to the bottom. And we don't want to establish that kind of system. Let me ask you briefly about some of the rent-a-bank schemes. I've been concerned over time about online lenders who essentially engage in these schemes to, quote, rent a bank, and therefore escape some state laws that protect consumers against usurious interest rates. Senator Brown and I teamed up and we worked on a CRA that overturned the Trump administration's rent-a-bank law that we thought opened the floodgates even further to this kind of price gouging. But I know that you and your team continue to look at this, and this remains an area of concern. Can you talk about concerns about online lenders and the practices they're engaged in, again, trying to route transactions in a way that avoid state laws to protect consumers, like in Maryland? We have interest rate caps. Can you talk briefly about that?
One of the most important parts of the CFPB was to cut down on the regulatory arbitrage that you see some firms try and play to get out of certain consumer laws, especially at the state level. So in some cases, they might just piggyback themselves to some bank or some institution in order to get around it. We, though, have authority over the non-bank firms, and we have taken a number of actions against them, and we are also working to make sure that all of those activities are legitimate and in accordance with the law. We do see a big footprint of online lending, and that can be good in certain circumstances, except if it's purely about arbitraging the law.
No, I appreciate that. I mean, there are obviously good actors in this space that are playing by the rules, but it's kind of the Wild West out there still. And I hope you will continue to make sure that folks aren't breaking the law and make proposals for how we can better protect consumers in this space.
I appreciate that. And I just want to make sure that the 17 billion number, I'll make sure I have the most updated estimate so that it's in the record appropriately in case I misspoke.
Senator Smith of Minnesota is recognized.
Thank you, Chair Brown, and welcome, Director Chopra. It's great to have you with us today. I'd like to use my time to talk with you about the proliferation of businesses and scams that are targeting homeowners. So we know that homeownership is a primary driver of wealth in our country, and that home equity represented about more than a quarter of household wealth in 2020, and that following the surge in home prices during the pandemic, homeowners have added like $8 trillion in wealth. But unfortunately, this seems like it's giving rise to some what look to us like some pretty dodgy businesses and just outright scams. So when you were here last, I think that you and I have discussed sort of the issue of exclusive real estate listing agreements and what that looks like. And now we're seeing this uptick in so-called zombie mortgages that are catching homeowners by surprise. Some second mortgage that they thought wasn't there anymore, and it is there, and now they're in a bind. And last month, ProPublica reported about a real estate flipping company that is targeting vulnerable homeowners and using deception, coercion to close sales, and these complex legal maneuvers nobody really understands how they work, that is hurting victims and keeping them from getting out of these unfair contracts. So, Director Chopra, this is what I want to have you talk about. When you were here in December, you noted that while the CFPB can't predict everything, the agency does have a role to play in preventing such issues from going nationwide. So I'm wondering, have you seen an uptick in these deceptive and exploitive products? What are you seeing, and what do you think, what are you doing to monitor and stay on top of this?
So, Senator Smith, I appreciate that, because there's actually something new that we're hearing too. Mm-hmm. I actually met with some Minnesota community leaders about contract for deed, targeting certain immigrant groups across the country. Yes. And I think what we want to make sure is, even where we might not have jurisdiction to go after a scam, we want to tell the Justice Department, tell the state AG, and we do, and tell others as well. I worry that because of the housing shortage, right, and housing affordability issues, a lot of people are looking at older homeowners who are sitting on a lot of equity. Many of them may be widowed,
right,
or limited English proficiency, and targeting them. And you mentioned that ProPublica article that obviously had some very troubling allegations. I don't want to comment on that in too much detail, but we obviously work by looking at the data, our complaints, but also by talking to people on the ground. One of the big mistakes in the lead up to the financial crisis is federal regulators ignored stories from the ground.
Exactly.
And that proved to be a pivotal mistake.
I completely agree with that because people, it was happening to them in real time, and they could explain they could explain the trend in real time because it was their life and their home.
And they have the documents often that are the
Yep.
canary in the coal mine
Yes.
to show who is funding this and who is orchestrating these schemes. And that gives us clues about where we need to target.
Yeah, I really appreciate that. And I think this is so concerning how these companies appear to be taking advantage of folks who are, as you said, older Minnesotans and Americans who don't understand what they're getting into, and they're being taken advantage of. Related to this, you know well that Minnesota has a very large entrepreneurial and really important Somali community. And we are seeing in Minnesota that this community has been targeted by these predatory land contracts. So we've heard concerns from advocates and from consumers about what this means. And so this is the specific thing I want to ask you about. We've heard some concerns from advocates and consumers that the CFPB complaint form is geared primarily for mortgages rather than land contracts or similar agreements. And so what happens is folks they can't figure out how to use it. It's difficult to report on. And so some people who have been victims are just sort of dissuaded from participating. So would you be willing to work with our office on this so that we could find an alternate way to get some of this report?
Absolutely, and we'll make
reported?
sure that they can even file with the Consumer Sentinel, so the AGs, we will work on that. We've actually tested with various groups of people of different backgrounds about how they use the complaint system. We can brief you on that.
Great.
And some state legislators in St. Paul also shared some of these issues with me, and we've been looking at it further.
Well, we'll follow up on that and
Please.
work closely with those legislators. So appreciate that. Thank you, Mr. Chair.
Senator Smith. Senator Fetterman of Pennsylvania is recognized.
Good morning, sir.
Good morning.
I am going to just say this up front. I am a fan of you and your work and at the agency. I think it really makes America better and more just and more secure from people. I'm also, showing my cards. That's kind of the brainchild of Senator Warren, my colleague, and I'm a fan of her as well too. And from Pennsylvania, a senator of Pennsylvania. Just in February, last year, Philip in Philomental area, Trident created a redlining majority-minority neighborhoods throughout the marketing, the sales, and hiring escorts. Trident contributed $18.4 million to a loan subsidy program for majority white signed neighborhoods. So in other words, you have been protecting a lot of mortgage holders in Philadelphia. That's right, one. So, but given all the good things that I've done in my state, the other goods that you've done, can you explain your thought about why there seems to be some kinds of critics that really want to tear you down and take it out?
Well, I will just say that our work to combat and stamp out redlining in the Philadelphia area, we did it in partnership with 3 states, including Pennsylvania, New Jersey, and Delaware, the DOJ. We got real relief to people. I do think that often law-abiding businesses don't necessarily always have their voice heard, and we protect them too. All of the mortgage lenders who follow the law in the Philadelphia area, they were disadvantaged by Trident's redlining scheme. And I think that's a place where the more honest businesses can speak up to, it is not just consumers we help all of those who do the right thing.
Yeah. So, I honestly am unable to understand why an agency as yours doing all those things, creating guarding against the individuals here is I can't really think of any a reason why that is the case. And now following up with my time left, I would like to, if there are any other imparts or any things you'd like to discuss about things in my state of Pennsylvania?
Well, certainly we see in Pennsylvania, which is not unique, is that whether it's rural, urban, or suburban, housing affordability is an issue in so many communities. And with higher mortgage interest rates, that's leading a lot of people being blocked from really borrowing for a home. So I want to make sure that over time, we have ways that if people get into trouble on their mortgages, they can modify them in a streamlined fashion. When the rate environment does go back down, that people can refi easily. And certainly in Philadelphia, Pittsburgh, and others, we do see a lot of scams that target older homeowners, and it's really a difficult challenge for us to combat. But we work closely with the state AG and others to do that.
Okay. And I'm now probably ceding the remaining time back to the chair.
Senator Warnock of Georgia is recognized.
Chairman Brown, thank you, Chairman Brown. I support the CFPB, and I was proud to join my colleagues in an amicus brief to the Supreme Court protecting the Bureau from another partisan legal attack. And I will continue working with the Bureau to protect the most vulnerable people in Georgia communities. I have long been opposed to onerous and unnecessary junk fees by banks and other financial institutions that do little more than extract wealth from hardworking families. And these fees are put in place to bring in extra profit for wealthy corporate executives and shareholders. When the nation's banks were before us last year, I pressed them to continue to end overdraft fees. For those that had, I encouraged them to not look to other areas to charge consumers and make up for these fees. Director Chopra, since your work against junk fees began, have you seen financial institutions shift efforts elsewhere to extract money from customers, vulnerable customers, especially the areas harder for customers to track and understand?
Actually, our analysis of certain bank account fees is that we see there's been big shifts in the market, and we haven't seen it being replaced with other fees yet. Part of it is because the more you make the fees up front, consumers are smart. They will switch to a different product if they see that there's higher upfront fees when they can shop easily. But we will be on the lookout for new types of fees that may not be lawful or that may be imposed in a less than scrupulous way.
We are seeing that, and thank you for that response. We're seeing in some of our savings accounts very, very low payments. For example, Wells Fargo pays only 0.15% interest. This is less than half the national average and less than 3% of the Fed funds rate. Other large banks offer only similarly low rates on savings accounts. Do you think it's possible that these large, very profitable banks are so slow to, why do you think they're so slow to raise interest rates?
Well, this is a problem across our banking system and frankly, globally. When interest rates are hiked, often borrower credit cards and others quickly go up, but savings account and checking account don't always go up so fast. Part of what the CFPB is doing is we're going to be putting into place rules that accelerate the shift to open banking. So this will allow faster switching, which ultimately will give consumers power without a lot of bureaucracy and red tape to get higher rates. That means banks will have to compete harder to keep them. And I think the benefits will be big for our whole country.
So you would support creating more marketplace competition as a way of addressing it?
Well, and also to reduce the friction and all of the challenges and roadblocks to switch. Often you have to change your auto debits, you have to change your direct deposit. we need to figure out how we can make that simpler and to the benefit of savers.
Thank you so much. Listen, I'm concerned about the effects that the Federal Reserve's interest rate increases have had on recent home buyers in Georgia. Georgia and the nation are in the midst of a housing shortage. For those who are able to purchase a home this year, they may not be able to maintain the stability owning a home brings. According to Black Knight, a mortgage analytics company, nearly 10% of folks who bought a house with a mortgage in 2022 are now underwater. 10%. Nearly half own less than a 10% equity stake in their home. Director Chopra, are these trends concerning to you as they are to me? And what is the CFPB doing to protect homeowners and potential home buyers on the verge of having negative equity, sometimes in homes they just purchased?
Well, we're watching the housing market like a hawk. When problems occur in the housing and mortgage markets, it can rebound into the entire economy. We do see that higher rates have led to dramatic reductions in refinancing volumes. Many people who need to move for work find them in a situation where if they sell their home and they have to buy a new one with a much higher rate, it really affects their family finances. So I do think the housing shortage in Georgia and elsewhere is a place we need to keep in mind as we think through how to police the mortgage market effectively.
I'm also worried about homeowners who do have equity in their homes being pushed to refinancing now in this high interest rate environment, risking their home in the case of a default. What steps have you taken finally in the past year to protect these homeowners?
Well, we are looking at ways to make sure that borrowers who get in trouble don't fall prey to some of those who are seeking to strip their equity. And part of it is we're looking at how we can make sure that loan modifications and the servicing flexibilities that we saw in the pandemic, are there ways to simplify some of the rules and guidance to make sure people can get those loan modifications and stay in their home and not fall prey to a scam.
Thank you so much. There's no question that rising home prices coupled with low mortgage rates encourage thousands of folks to purchase homes or to refinance their existing mortgages. And now that interest rates are increasing, slowing or even lowering home prices in some areas, Congress, it seems to me, and the CFPB must ensure that that those just trying to achieve the dream of homeownership are not instead signing up for a nightmare. Thank you for your work on this.
That's it. Okay, we're done. Scott will deliver a closing statement.
Yeah, let me just very quickly say that you and I had a conversation about the late fee and the structure of it. One of the concerns I have is not whether or not people pay a late fee. I don't have that question. I think people pay the late fee. The only question is, what do you call it? Do you call it a late fee, or do you just embed it in the overall structure of something? So you and Senator Warren had a serious conversation about that late fee that I said was $8. You said that's not quite right, but the truth of the matter is that I suggested that you're really good at verbal kabuki, and you really are. But at the end of the day, the question I have is, when you don't consider the total cost of collecting something, then that becomes embedded in the overall structure of that organization, which then hurts access to products. It likely will increase the interest rates. And as a kid who grew up in a single-parent household mired in poverty, the one thing I can tell you is that the people who pay the additional cost that you don't see are the folks at the bottom of the food chain economically. And I want to make sure that when we have that consideration, that we're considering it holistically, not whether or not we're paying the late fee. I don't think that's a part of the argument. The argument I had, sir, was about the importance of making sure that when you can see it, you can bill for it. And the cost that you associate with the late fee had to do with the pre-charge-off cost, is what that fee structure is based on, when in fact there's more to that, which simply to me means that the average person in the nation that struggles with paying bills will have fewer products to choose from, which means that the alternative is to go to a different marketplace where there are no caps, and that is dangerous. Thank you, sir.
Thanks, Senator Scott. I think the discussion of late fees suggests that Wall Street is entitled to big profits. To eliminate late fees doesn't mean that some other consumer is going to pay. It means maybe these voracious and very profitable large banks might just make a tiny little bit less profit. Director Chopra, thank you. And the CFPB have shown that they're ready and willing to stand up to the biggest banks, the most powerful corporations. This committee, the majority of this committee, appreciates what you do every day. We heard about a number of actions CFPB's taken to protect hardworking Americans, preventing their homes and cars from being repossessed unfairly, to cracking down on junk fees, to working to prevent excessive credit card fees. Here are just a few of the many actions that you are pursuing to continue this mission to protect consumers. That's why you exist as an agency. That's why you wanted to run that agency. That's what you're doing. Thank you again. For senators who wish to submit questions for the record, those questions are due 1 week from today, Tuesday, June 20th. Director, please submit your responses to the questions we send you for the record 45 days from the day you receive them. Thank you again. The hearing's adjourned.